Welcome back to another engineering economics video. We're in chapter 9 talking about depreciation. And in the last video, we talked about the straight line method of depreciation and introduced the idea of the declining balance method. And so we're going to start this video off by doing an example problem that demonstrates the declining balance method. So in this example here, we have a computer system, we're going to say, instead of an automobile. You'll see, though, that the numbers are actually the same from the previous problem. And the purchase price or cost basis is $10,000. It's going to have a useful life of 5 years, and when we're done with it, we're going to sell it for $2,000. We want to compute the annual depreciation allowances using the double declining balance method, which means that we're going to use a multiplier of 2. So I mentioned in the last video that when using the declining balance method, we take the 1 over n. We're going to basically divide 1 by the number of years. So in this example problem, the asset has a 5-year life. So 1 divided by 5. And then we're going to multiply it by the multiplier, which can vary depending on the type of declining balance method you are using. Common values are 1.5 or 2. Our problem statement said that we want to use the double declining balance method. So that means we are going to take that 1/5 and double it. So 1/5 would be 20%, but we are going to double it to be 40%. So basically what this means is if we were using the straight line method, we would have reduced the value of the asset, the book value, by 20% each year. With this method, we're going to decline it by 40%. Here's the thing we need to watch out for, though. We can never depreciate an asset below its salvage value. So once we get down to the salvage value, then that's just where it stays. That's where the book value stays until the end, the useful life of the asset. So here is the spreadsheet I created earlier, a screenshot of it. So we're starting off with a $10,000 value, and instead of reducing the value by 20%, we're going to reduce it by 40%, and until we get down to our salvage value, which is $2,000, and then that's where it stays. So let me bring up a blank Excel sheet and show you how to get these values. So I guess this isn't exactly blank. This is the same spreadsheet we used for the straight line method. In fact, I could maybe insert a couple rows here, and right at the top here, this is the straight line method. And I'm going to copy this. And this would be the declining balance method. So same values here: cost 10,000, salvage 2,000, life 5,000. So instead of having the same DN, the same depreciation amount every year, what we need instead is we want to find out what is this alpha value. Let me insert a symbol alpha. There it is. And so what is alpha? Alpha is 1 divided by our number of years, the life of the asset, multiplied by some multiplier. We're choosing to use 2. Okay, and that shouldn't be a percentage, that's just a number. 0.4 is the, or 40% is the alpha value. So if we start here, let's get rid of these values. Start with a balance of $10,000. our dn, the amount by which we're going to depreciate this asset, is going to be equal to our alpha value, the 0.4 or 40%, multiplied by the previous balance. And I want to be sure here to lock in that row 6. I want to be able to copy this formula without this cell reference moving down. Okay, so in the first year, I'm going to depreciate the asset by 40%. So it's going to go from 10 minus 4 is 6. And then the beginning of the next year is going to be 6,000. And so in the second year, I'm going to depreciate the asset by 40% of 6,000. So it's going to go from 6 down to, it's going to depreciate by 2,400, and now it will be worth 3,600. And that's what it will be worth to start the next year. And then it depreciates by 1,440, which gets us down to 2,160. And then it depreciates by 864, but that's going to take us down to 1,296. And there's a problem with that. We cannot depreciate this asset. We cannot say in our books, in our balance sheet, that it's worth less than what its salvage value is. We're going to sell it for $2,000, so this cannot go below $2,000. So in this year 4, we actually cannot take that 40% that depreciation amount. That's too much. The maximum we can depreciate it by is 160. So I'm going to delete that formula and instead put in 160, which takes us down to our 2,000 value, which means in the last year, in year 5, we don't depreciate it at all. The depreciation is 0. And so that book value just remains 2,000 in year 4 and also 2,000 in year 5. So as I said, the reason why you might want to use a declining balance method is it front loads the depreciation. We have more depreciation at the beginning of the life of the asset and less at the end. And this might actually be a more accurate representation of the market value of the asset. Again, think about owning a car. In the first couple years of owning that car, the value of it is going to drop down, down, down. And then towards the end, it's going to sort of level out. It doesn't matter how many miles you put on it, how old it gets. It's still, as long as it's a working, functional car, might still be worth $2,000. Okay, we've got one more method of depreciation, book depreciation to look at, so let's take a look. Okay, I almost forgot here. Before we get to the third method of book depreciation, it is allowable to convert at any point in time you choose between different methods of depreciation. So, for instance, you may start off depreciating your asset using the declining balance method, and at some point you might decide, you know what, I think I'm going to switch it up to the straight line method, and that's acceptable, that's okay. And so the way you would do that is to find what that depreciation amount is. Just take whatever its existing book value is, even if you're in year 3 or 4 or wherever it is in the depreciation process. You take its current value minus the salvage value to get the net value remaining, and then divide that by the number of years left on the life of the asset to get a depreciation amount dn, and then you would just consistently subtract that depreciation amount from the book value each year. Okay, the last type of book depreciation that we're going to look at is units of production method. And this might actually be one of the more honest ways of looking at depreciation, I guess you could say, or at least it ties the depreciation to a measurable quantity. So with the straight line method, you're just taking the value and evenly dividing it up over the number of years. And although that's mathematically simple and tidy, it may not be a great representation of the actual value of the asset over time. The double declining method might be a little bit more accurate to the actual market value of the asset, but it's a little bit more theoretical in its approach. Whereas this third method, the units of production method, is actually tied to a measurable quantity. The best example I can think of is the number of miles on the odometer of a car. You track how much you've used the asset, and every time you use it, it loses its value. So units of production method would essentially be like tying the value of the car directly to the miles on the odometer. And so using this method, you have to calculate the depreciation amount each year. It's going to be different depending on how much you use the asset. So in the numerator of this fraction is the units, so maybe the miles or the hours that the piece of equipment has been used, divided by the total units. So let's say we're talking about a car. You buy the car and you're going to put 100,000 miles or 200,000 miles on that car before selling it. So the total units would be the total number of miles or hours or the total amount that you plan to use that asset before you salvage it. And then you multiply that by I minus S, which is the investment minus the salvage. So in other words, this is the net cost right here. Let's look at an example. Let's try to get through this in the next 3 minutes. We have a truck for hauling coal that has an estimated cost of $55,000 and it's expected to give service for 250,000 miles, resulting in a $5,000 salvage value. Compute the allowed depreciation amount for a truck usage of 30,000 miles. So in other words, we're going to use that truck for 30,000 miles in a given year. How much of its value did it lose in that year? So 30,000 is how much we're using it in that one particular year. Over the life of the truck, we plan to use it for 250,000 miles. And so we take the 30 divided by 250, and then we multiply it by the net cost of the truck. We bought it for 55,000. We're going to sell it for 5,000. So when we do that, when we take 30 divided by 250 multiplied by 55 minus 5,000, we get a depreciation amount of $6,000. So in that particular year, if we drove the truck 30,000 miles, its value, its book value, would have decreased by an amount of $6,000. And so this unit of production method is basically used on a year-to-year basis. Each year, you'd have to calculate what that depreciation amount is and then subtract it from the value in the previous year to find out what its new value would be. And then eventually it would go down to its salvage value and you would sell it. Or if there is no salvage, it would just be completely depreciated. In other words, the book value would go all the way down to 0. Okay, so that's the last of our book methods of depreciating an asset. And we're just about to our 15-minute limit. In the next video, we'll talk about tax depreciation methods.